Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with the breakdown of the action, not only today, but also what we saw go down this week, Ed, and there is a lot to talk about.
Yeah, it was a stomach-churning ride. It seemed like it was going to be fun for a while, then it really took a nasty turn. I want to take a look at a few stocks that are holding up in a way. Dollar Tree, a new IPO, Excelerate Energy, and then Apple, which is holding up in a way, but also is an absolute loser.
Yes, we'll provide the IBD perspective on all of those three stocks and so much more. But first, let's take a look at the major indexes. So the NASDAQ today down by about 1.4% by sessions close. The S&P 500 down 0.6%. The Dow down just 0.3%. So the least hard hit there. And the Russell 2000 down by 1.7%. So not how we would have wanted to finish the week out, Ed, when midweek we saw some promising action, but like you said, a very stomach churning turn of events by the end of the week.
Yeah, we started off with a rally on Monday, and we're going, okay, we started a rally attempt, and not much going on Tuesday, and then Wednesday. Initially, we sold off, but then came up sharply. It was on the Fed meeting. They raised rates. They're going to start cutting on the balance sheet. But then it really took off when Fed Chief Powell said, "Hey, we're probably not going to do a 75 basis point hike on Wednesday." So that really lifted things right up to the close. And so we were starting to look, hey, maybe we could get a follow through day. We have the Fed out of the way. But sometimes what happens, you get a delayed reaction.
Right.
Obviously, the bond market and some other situations rethought things, and so the market just tumbled Thursday, gave up all of Wednesday's gains and more, and then continued to fall on Friday. The NASDAQ has actually fallen back to the lowest levels since late 2020. So that ended its rally attempt, and you can see it's just continuing to fall. It's really discouraging when you see that when we had that gain from the beginning. I mean, yeah, we were down for the week, but it was so much worse from Wednesday. And the S&P 500, it's doing a little better, but it's barely above Monday's lows. So the rally attempt is technically there. I'm not sure if we may have closed higher for the week, but it didn't feel like we closed higher for the week. We just avoided by like 5 or 6 points this morning. Technically we could get a follow through day on the S&P and the Dow. But I think we'd all have to be a little skeptical if that happens in the near future. So we'll have to see if that can go on, or if we really make a new leg in this correction/bear market.
Yeah, that's right. And it seems like every time we start to get a little bit of upward momentum, we're at oversold levels. Fear is increasing. Bearishness is increasing. We get slammed down again. But on the other hand, Ed, it does seem to appear that there is a lot of complacency that's still out there.
Yeah, we haven't, we could call up maybe 0 VIX, and okay, fear is coming up a little bit. I'm not sure where we close because this might be a little delayed.
Right.
But, okay, there was a spike in the morning, but then even though the market, we still haven't hit those new highs. And so there's some other evidence. We'll take a look at ARK and some other growth funds were still taking money in during this week, even though growth has just been really weak, for a long time.
Right.
So there's just sort of a feeling like people are still betting, I think it's going to bottom. And you could be right. But the problem is if everybody else thinks there's a bottom and everybody else is still secretly bullish, until you get that capitulation selling, that panic selling, it's hard to really break that fever, as it were.
Mm-hmm.
And so it's not encouraging in that regard. We may need a lot more fear before things can turn better.
And we'll dig into that more in kind of our final thoughts wrap up, but let's move forward and take a look at the 10-year Treasury yields, ERT X and Market Smith continuing to press higher here, Ed, without signs of slowing, really.
No, it fell a little bit on Wednesday. I mean, not much, but it fell on the Fed news. It's like, hey, well, it took this news in stride. And then it's like, well, that was a real change on Thursday. And just powered past 3%, closing above that level for the first time since late 2018. And honestly, it's getting very close to 3.25, which would be the highest in 11 years. I mean, it's not just a short-term high anymore.
Right.
It's actually becoming significant. And while this chart doesn't go back far enough, really since the early 80s, treasury yields, the long-term treasury yields, have been coming down for a long, long time. And that's helped boost valuations, especially for, growth stocks. And so this trend has been broken. And even if we level off and come down, it's still going to be an issue that we're not going to get that, probably not going to get that tailwind, like in that like secular long-term fall. But certainly as long as this goes up, it's hard to see how growth stocks and the market generally are really going to prosper.
Right. Does it seem too extreme to say that this is a seismic shift in the market's foundation right now?
I mean, it's certainly what's driving everything. I mean, whatever you want to call it, it's certainly what's driving everything. I will note that the CPI, the Consumer Price Index, and the Producer Price Index are next week. We probably need to see a lot of reports showing some cooling to really, get the Fed to slow down and everything. But that'll be an interesting report. But until that dynamic changes, it just changes everything, and investors just have to note that.
Yes. All right. And moving on, let's give a little bit more color to what we saw underneath the surface in terms of the various industry groups. So here's a look at the XLE ETF, up by about 3% on Friday. So getting back on its feet, up 10% for the week, Ed, after 2 down weeks in a row, although last week was a pretty nice support week. So this leading group continuing to lead.
This is still doing very well. A lot of strong earnings reports, and the companies are still focusing on shareholder returns. Oil prices rose. Refining margins are great. So, the integrated oil giants, the refiners, LNG plays, those are all among the really leading areas. But there's plenty of names in the oil and gas space that are doing well. You really want to go through this whole sector and decide what you want to do. You want to have too much exposure.
Right.
But if this is probably the one area where if you're going to have exposure, this would be it, in this kind of area. So this is doing well, but not a whole lot else.
Right. And even still, it seems like, focusing on pullbacks versus breakouts is also warranted, because take a look at when XLE last tried to break out. It quickly pulled back to a key level. So it seems like especially after a 10% move here in XLE. So therefore, a lot of names in the group, not all, but a lot of them had big weeks this week. Maybe wait to see if there's a little bit of pause here from this point before just jumping in and adding exposure, because all right, the leading group is indeed leading again, not breaking down further.
But I think that's an excellent point, because even here, pullbacks have probably been the way to go. There's pretty big they can be pullbacks. I mean, they don't look so big after the fact, but there's been some noticeable drops here, and so you don't want to be buying up at that top, because you don't know, because oil could suddenly start falling off. I mean, there's reasons to be bullish, but their conditions could change pretty quickly on a lot of commodities depending on geopolitical events.
Right. And now let's also take a look at XME, because the metals and mining group is one that we've been tracking very closely in the first couple months of the year, but seeing a little bit of divergence here. It looks like not having a great week. So 3 down weeks in a row, all in heavy volume for XME. This week down by about 3.7%. And then so if I go to a monthly chart, it looks like, last month we saw a drop by about 8%. And so far this month, down almost 4%.
Yeah, and what's interesting is the miners sold off a couple weeks ago, and that's sort of half of it. And then the steel stocks, sort of a lot of them broke through, some of the leaders in the steel group, they broke through their 50-day lines this week. And so it's just a sign that even in these leading groups, there seems to be narrowing, and some of these groups are falling off. I mean, it's just, in a market correction like this, it's just tough to hold up in any sector. Energy's doing it, but even there, it's oil and gas. It's the uranium stocks sold off, the solar stocks that were coming up. I mean, so it's coal and some oil and gas. So it's just a very difficult environment.
Right. And so a sell signal that we like talking about a lot is a decisive break below the 10-week line, 2% or more typically, with some caveats, but down by about 3.8% last week and headed even lower this week. So maybe at the very least, this group needs time to digest the gains over the first couple months of the year, and maybe we'll start to see more of these stocks for new bases, but it could take time, and that doesn't necessarily mean that this group will regain its footing anytime soon. And now next on our list, let's take a look at XLV. And this is the Healthcare ETF. So seeing some deterioration here, Ed.
Yeah, I was actually surprised. I didn't realize how much it had pulled back. I mean, I had seen it before, but I had to be reminded of it because health insurers are still doing pretty well. And some others are actually, there's more in that group that are coming up now. And some drug makers are coming up, but we've seen some of the biotechs pull back quite a bit. Hospitals have sort of broken apart. Medical products have sold off hard. So, again, there's narrowing. It's just these little holdouts that seem to be doing well. Will they continue to hold out? I don't know. But so again, it's just that kind of market.
Yes. And as we mentioned earlier, ARKK worth reviewing as well, down by about 4.5% on Friday, down 3% for the week. So midweek, we did see a pop here, Ed, up 5%, and Wednesday marking the largest inflows for the ETF.
I think it might have been Tuesday, but I'm not sure actually. I'm not sure if we have data for Wednesday or all the things in there, but yeah, I mean, some big inflows. And it is, look, ARK has its philosophy and maybe it'll work, but the key is that you're still seeing investors saying, I want to buy the dip. I'm bullish. That's basically what it comes down to. I think these are going to take off. And yeah, you can tell yourself, well, it might go down for a little while, but you wouldn't be there wouldn't be so much money coming into this and other growth stocks, growth funds, if there wasn't that sort of bullish sentiment. Until people say, like, I'm getting the heck out, I don't care, I'm getting out, and showing up with other fear gates, like really doing that, you may not get that sense of a bottom until everybody is off, until everybody gets out onto the sidelines, then you're not going to get, money to come back in.
Right. And, in our view, it doesn't matter what the ticker is. It could be any combination of letters. If you are seeing a chart that looks like this is something that you want to avoid, not try to play it like a casino bet that you're getting in at the absolute lowest price. If you're talking about gambling, well, try going with something where at least the odds are in your favor. That's always what we want to be doing. And when you're trying to buy something in a severe downtrend like this, you are not putting the odds in your favor.
Yeah, absolutely not.
All right, moving on, let's take a look at some stocks. Well, we've been talking a lot about inflation and Dollar Tree, perhaps. Is this an inflation play here, Ed, that investors should be interested in for their watch list? We did see a nice upside reversal at the 50-day line today, although it did lack volume.
Yeah, it lacked volume, and you can sort of see like it needs maybe a little bit more, to get above sort of, you drew a trend line there, maybe get above this past week's high. Then you could argue, okay, then that's sort of clearing some resistance. That little area might be a little bit more. Again, it's a tough market to be doing that. This is a leader that relative strength is at highs, but it has been pulling back. I mean, it's been doing it in a fairly orderly way. This could be great, but in a tough market, it might struggle. It might, there was a lot of stocks like fertilizer stocks held up around their 50-day line, and now we're starting to struggle. This is still looking good. You're right. An inflation play because consumer staples are doing well. People are still going to spend money. They have to buy food and some other basic products. They want to save some money on it. They might skip other spending like discretionary spending, but on your basic items, and that will still do well. Profits have fallen for a few quarters, partly on tough comparisons because they were really inflated before, like in 2021. But it's supposed to really bump up this year, and so that's a positive sign. Yeah, nice action. You're the one who brought this up to my attention, so it's like, yeah, that's a really good looking. That's a good looking stock there. So I appreciate that. Thank you,
Oh,
Allie.
well, I'm the only person, only investor who's looking at Dollar Tree. So I will take all of the credit for that,
Very
Ed.
good.
No, a group effort. It's definitely been on the radar of our team here, but it is interesting, and we'll have to see. If it did have a stronger volume today, and we were in an uptrend, I think you could definitely make the case for adding a little bit of exposure here. But not only do we not have the volume as we mentioned, and maybe it needed to get a little bit more of a boost on the price gain, but not only that, we're still in a correction, and we need to see a follow through day. Bottom line, the last couple of attempts have not panned out. Including this week with a big exclamation point. I think of markets not ready for the follow through day yet, Ed.
It does not feel like it. It'd be very worried. It'd be an odd follow through if we followed through on Monday, barring some seismic change, as it were. That doesn't seem to be in the offing.
Mm-hmm. All right, we'll see. We're going to remain flexible. But let's take a look at this recent IPO EE, which you pointed out on the weekly chart here. We are seeing that relative strength line blue dot. It looks like it has 4 weeks of trade under its belt now. So potentially setting up an early entry here, and utility gas distribution, it's in the right area.
It is, and this is what it does is it has floating natural LNG terminals. So it's an LNG play, and obviously LNG, we've seen it with some other stocks really taken off because there's so much demand. Because natural gas prices are just so much higher in Europe than they are in the United States. When we complain about fuel costs, it's nothing compared to what Europe is doing. So a lot of areas there, you built the trend lines in there. You sort of tried to get above a trend line, like if you did a trend line from the top of the actual top of the chart,
steeper.
It's sort of broke one today, but then failed. So in any case, I think if the official IPO base is still a ways away, that would feel like it would be getting sort of extended. So if you wanted to play this, 8% doesn't seem that much, but in this kind of market, certainly would seem like it. But if it got above today's high, that might sort of be a break of a trend line, and could arguably would be entry. That would be another entry right around 28. Places to go. I mean, it's nice. There's not many IPOs this year, but LNG play, it's already profitable. It's supposed to have earnings growth of 728% or 726. That's pretty good profit growth. Pretty good there. So that would be something that to keep in mind. It's as we go ahead in this year. One more energy play to be taken a look at.
All right, Econ Ed likes EE. We'll keep it. Maybe that'll help me remember it, so I can check back in on it next week. In addition to, of course, setting some alerts, that'll also help. You make sure it stays on my radar. All right, and last but not least, let's take a look at Apple. The relative strength line holding up, so it's at least keeping pace with the S&P 500. But just because it's keeping pace with the S&P doesn't mean we should be investing in Apple right now, Ed.
Yeah, I mean, on a weekly basis, this one actually I think is a blue dot. It's been that kind of. It's now closed, I believe, for 6 straight weeks, and some of those weeks haven't been that bad. Like this week, just a fraction, but it's down for 6 straight weeks, and the RS line is right at highs. Has been this week at least at one point, and yet it's come down. Yeah, this is the situation in a bad market. You can be a relative winner, but an absolute loser. It's fallen quite a bit over the last several weeks. Maybe it'll be a leader in the next uptrend because it is holding up, but right now it's not. And there's always the risk that it really breaks. That some we've seen that with other stocks, some leading groups looking great, and then they aren't. I'm not saying that'll be the case with Apple, but during a correction, you watch them, and then sometimes you have to replace them. They look like they're holding up, and then they don't. So this is one to watch, but it's not one to really participate in because it is losing ground. It's not, and it was looking pretty good just a couple of days ago, but it's been losing ground, and in this kind of market, not much is going to work.
That's right. All right. Well, we'll keep it on our list and see how it acts next week, and more importantly, how the market acts next week. Thank you, Ed. And before we go, what do you think investors should be focused on as they prepare for next week? It seems like, again, it's time to have a lot of cash and wait for conditions to improve.
Yeah, I think it's just you want to be in cash or nearly entirely in so. The only exception would be like a little exposure to a leading sector like oil or long-term holdings with major gains like that you've held for a long time. Just remember that the market can sell off a lot faster and deeper than it rallies. We had such a nice game on Wednesday and it took so little time to give that all back. So, if you do have things, maybe take partial profits, be ready to cut losses immediately. We've just seen how much stocks have fallen. You just don't want to let them build up. And don't try to guess the market bottom. Just wait for the market to get better. Your focus should be on keeping your powder dry, keeping your mind fresh, and working on your watch lists.
All said, Ed. Thank you. And thanks everyone for tuning in. We'll be back with more on Monday morning on IBD Live. So make sure you join us. We will be providing an update on our weekly industry group analysis, something that's very key to our show on Mondays and has helped us stay in sync with the market and focus on those leading groups. So looking forward to that and so much more on Monday's shows. So make sure you join us, investors.com/IBD Live for more details. We'll see you there, and we will see you Monday after the close. We hope you have a great weekend, everyone. And make sure you join me in a little over 30 minutes from now. I'm going to be having Stock Tales with Scott St. Clair. Looking forward to a fun and enlightening discussion with him over live on my YouTube channel, and we'll also post it to investors.com/videos. See you there, and see you right back here on Monday.